Welcome back to Financial Guru, your one-stop shop for everything finance. Today we will learn about Uber technologies. UBER is the ticker symbol. We better Uber on out of here, as my food is getting cold and I'm getting hungry. All joking aside, it is time to learn about Uber. History from where it all began. Look at the acquisitions they have brought along the way. Some of the issues they have had. We'll also look at Uber move away from autonomous driving. Or are they still involved? We will compare Uber and LYFT financials and then give a final recap on what we learnt to see if Uber is a potential buy or not. It's time to learn about Uber stock. So let's first look at the history. Global ride-sharing application founded in 2009 disrupted modern transportation as we know it, and at one point grew to become the highest valued private startup company in the world. 10 years after Uber's founding, the company went public on May 9, 2019, though the road to there was very bumpy. As we head off to Uber headquarters, remember the Dodgem cars, bumper boats and bumper cars as you were a kid or even still now? These rides were at an amusement park were well ahead of their time, just like the Jetsons flying hovering spaceships. The world is heading towards automation, and Uber is one of the leaders chasing their dream of autonomous cars. Or are they? We'll find out later. But we must go back to the future to understand the path, for where it all began, in Paris. Uber's story began in Paris in 2008. Two friends, Travis Kalanick and Garrett Camp, were attending the LeWeb, an annual tech conference is where revolution came together to plot the future. 2007, both men had sold startups they co-founded for large sums. Kalanick sold Red Swoosh to Akamai Technology for $19 million, while Camp sold StumbleUpon to eBay for $75 million. The concept for Uber was born one winter's night during the conference when the pair was unable to get a cab. Uber was founded on a single idea. What if you could request a ride from your phone? Initially, the idea was for a timeshare limo service that could be ordered via an app. After the conference, the entrepreneurs went their separate ways, but when Camp returned to San Francisco, he continued to be fixated on the idea and brought the domain ubercab.com. The beginning of UberCab. In 2009, Camp was still the CEO of StumbleUpon, but he began working on a prototype for UberCab as a side project. By the summer of that year, Camp had persuaded Kalanick to join the UberCab chief incubator. The service was tested in New York in early 2010 using only 3 cars. The official launch took place in San Francisco. Ryan Graves, who was Uber's general manager and an important figure in the early stages of the company, became CEO of Uber in August 2010. By December 2010, Kalanick took over again as CEO, while Graves assumed the role of COO and board member. The simplicity of ordering an Uber ride fueled the app's rising popularity. With the tap of a button, a ride could be ordered, a GPS identified the location, and the cost was automatically charged to the card of the user. The San Francisco-based startup quickly became one of the hottest companies and grew quickly. The first Uber ride was requested in 2010, and just 2 years later, in 2012, Uber had already launched internationally in Paris, where the idea for Uber first took place. Soon after launching, UberCabs had its first roadblock with its name. In October 2010, the company received a cease and desist order from the San Francisco Municipal Transport Agency. One of the main issues cited was the use of the word cab in UberCab's name. The startup promptly responded by changing the name UberCab to Uber and brought the uber.com domain naming rights from Universal Music Group for only a 2% stake in Uber, which Universal then sold for a measly $1 million a few years later. If they had kept it, they would be super rich now. Around the same time, the company received its first major funding, a $1.25 million round led by First Round Capital. By then, Uber was already on the watch list of many investors. 2011 was a crucial year for the Uber growth. Early in the year, the company raised an $11 million round of funding led by Benchmark Capital, and it went on to expand to New York, Seattle, Boston, Chicago, and Washington, D.C., as well as Paris. In December, the 2011 LeWeb conference, Kalanick announced that Uber raised $37 million in Series B funding from Menlo Ventures, Jeff Bezos, and Goldman Sachs. In 2012, the company broadened its offering by launching UberX, provided a less expensive hybrid car as an alternative to the black cars. Surge pricing backlash began. Uber uses an automated algorithm to increase prices based on supply and demand in the market. On New Year's Eve 2011, prices soared to as much as 7 times standard rates, fueling negative feedback from users. Uber committed to capping surges pricing during several blizzards in New York. In 2014, taxi drivers in London, Berlin, Paris, and Madrid staged a large-scale protest against Uber. Taxi companies have claimed that since Ubers avoid their expensive licensing fees, bypasses local laws, it creates unfair competition The case was heard in Europe's top court. In July, Uber became the most valuable startup in the world, valued at $51 billion after the funding round. In June 2016, Uber raised $3.5 billion from Saudi Arabia's Wealth Fund. With Uber's rapid growth came many controversies and knocked down the firm's valuation from a lofty $70 billion to $48 billion in January 2018. On May 23, 2018, the company announced a new tender offer that would bump the company's value to $62 billion. In April 2017, Uber opened up about its finances for the first time to Bloomberg and reported a global loss of $3.8 billion for 2016. This included losses from its China business, which it sold in the summer of 2016. The company also told Bloomberg that the more it shifts to its Uber pool, the carpooling service, the faster the revenue grow, and this shift made the fourth quarter of 2016, it got a little bit brighter with a revenue increase of 76%. Uber also had some culture controversy along the way. And that's when Kalanick was out and Dara was in. In 2017 was a rough year for Uber. The trouble began in February when a former female Uber engineer ousted the company for its sexist culture. In a 3,000-word blog post, it was alleged that Uber's corporate culture was highly hostile, sexist, and quite offensive to most people. The post went viral and a number of high-level employees were let go or resigned for reasons relating to the allegations in the following months. Following the blog post, the board called for an international investigation which became known as the Holder investigation. It was led by former Attorney General Eric Holder. The investigation resulted in 47 recommendations intended to improve the culture and work environment. According to Uber, the firing of more than 20 staff members. In the following months, scandals seemed to haunt both the company and CEO. Letters were released to the press which confirmed that sexist attitude came from the top down, including from Kalanick himself. He was also caught on video arguing with an Uber driver about lowering fares, which did not strengthen his image in the public eye. Simultaneously, Uber was being sued by Alphabet, with Waymo, the autonomous driving, claimed that a former employee of theirs stole secrets relating to self-driving technology. That case was settled in early 2018. On June 21, 2017, Kalanick resigned after shareholder revolt. After a little more than 2 months, it was announced that Dara Khosrowshahi, then CEO of Expedia, would take over. Dara came to New York in 1978 with his parents to escape the Iranian Revolution. He started his career in finance as an investment banker and eventually became the CFO of IAC Interactive Corp, a position he held for 7 years before becoming the CEO of Expedia. In 2018, Japanese conglomerate SoftBank Group, along with a group of investors including Dragoneer Investment Group, successfully bid to buy into Uber stock before it went public. The deal reportedly gave SoftBank 15% in the rideshare company, with Uber getting a powerful ally in Asia. Sadly, the self-driving Uber vehicle was involved in a fatal crash. Additionally, on August 8, 2018, the New York City Council voted to put a pause on a new license issued to ride-hailing services such as Uber and Lyft. By May 9, 2019, Uber IPO'd on the stock exchange, where they made history as the biggest first-day dollar loss in IPO history in the United States. At one point, Uber was valued at $120 billion by Wall Street analysts, which would have made it the largest company ever to debut on the stock market. After its IPO, it was only valued at about $69 billion. What a disappointment. In 2020, Uber struggled to become profitable, largely due to the decline in ride-hailed services during the rona. Now let's look at one of the issues Uber had with employees, or should I say contractors, in New York. It surfaced that Uber had mistakenly charged drivers commission based on pre-tax earnings, as opposed to after-tax earnings at a cost of tens of millions of dollars to the New York drivers. The company said it was an accounting error and it was committed to paying its drivers back in full as quickly as possible. The issue does raise questions about the fairness of who ends up paying the tax. Drivers' advocacy groups have argued for some time that Uber is avoiding a tax at the expense of its drivers, something the New York Times found evidence to support. Paper estimated it could have cost drivers hundreds of millions of dollars. On June 13, 2017, a New York judge ruled that Uber drivers should be considered as employees as opposed to being independent contractors, like companies had argued, at least in certain cases. This decision opens up for drivers to receive employees' benefits, which would likely have a significant impact on the bottom line of Uber. In addition, August 2018 restrictions on licenses by the New York City Council was a blow to Uber and meant a pause on any new licenses for the ride-sharing service in the city for a 12-month period. Meanwhile, California passed Proposition 22 during its November 2020 election, allowing companies like Uber to classify their workers as independent contractors in the gig economy and not as full-time employees. The ballot is now the costliest in California history, with over $200 million spent in passing it. Now it's time to look at Uber's acquisitions and current businesses within the company. First, we will look at Uber Eats. If you didn't already know, Uber has a merchant delivery program for food delivery called Uber Eats. The rona caused havoc in 2020 and into 2021, but Uber Eats, it was a dream come true, helping to save Uber's main rideshare business. Many developed markets gave rise to the couch comment and an increase in engagement for food delivery services. I think the rona has fast-tracked people towards more food delivery just for time saving, as waiting in line, wasting gas for 30 minutes to 1 hour at peak times. Very annoying at a fast food restaurant. So yes, it may cost you a little extra, but you don't have to use your own car. Beautiful. Anyway, as a result, Uber Eats experienced a positive spike in many metrics, including an estimated 152% year-on-year increase in revenue. For the year 2020, Uber Eats generated around $4.8 billion in revenue, compared to just $1.9 billion the year before. Uber Eats also has more than doubled its gross bookings in 2020, with an amount of $30.2 billion compared to just $14.5 billion in 2019. As of March 2021, Uber Eats holds the second highest shares of the online food delivery market in the US at around 22%. Notably, Uber Eats shares of the market recently increased closer to 30% with the recently completed purchase of Postmates, which had an estimated 5% share of the market in the same reporting period. Uber ever increasing reach. Uber Eats has steadily increased its user base over the years, and in 2020 it is estimated that the food delivery service app had 66 million users compared to just 5 million in 2016. Uber Eats also claims to have increased the number of cities that they operate in to 6,000 in 2021, a staggering 500% increase from the 1,000 cities. Many restaurants turned to the food delivery app as the dine-in options were forbidden in many parts of the world. As a result, in 2020, Uber Eats supported over 600,000 restaurants compared to just 220,000 in 2019, for a staggering 173% increase. Uber Eats was integral to Uber's business during the rona, when the riding-share industry was essentially put on hold across the globe. Uber made the decision to integrate the Uber Eats service into the main Uber app, with the idea being the more problems Uber can solve on one app, the more frequently it would be used. As Uber continued to roll out of the singularly integrated app, offering both rides and eats, the super app now contributes more than 10% of first-time Uber Eats orders. The exciting opportunity in 2021 is for that process to work in reverse. That is, Uber Eats customers choose Uber for a ride to their local bar or to the airport because the app is already on their phone. CEO Dara believes the way we think about the new Uber is this: if Amazon owns next day, we want to own the next hour. Another high-profile acquisition occurred in July 2020 when Uber announced that it was acquiring food delivery app Postmates for $2.65 billion. Uber's recent purchase of Uber Eats competition Postmates is sure to strengthen Uber's hold on the online food delivery service market in the US and may finally lead the food delivery service app to profitability. Uber, in partnership with Barclays, rolled out co-branded rewards credit card in the US. But one investment that started with a bang but looks like crashing down to earth is Lime scooters. On July 9, 2018, it was announced Uber is investing in the electric scooter rental company Lime in collaboration with Alphabet Incorporated Google. Lime was founded in 2017 and has raised $467 million thus far. The lightweight scooters are available for rent all over the cities around the world as customers leave them on the sidewalks for the next rider, making for a convenient and clean energy-based business model. The deal is part of a $355 million investment round, and the business was valued at $1.1 billion. Uber plans to promote Lime through its app and brand its own logo on the scooters. Uber made similar efforts with the startup Jump Bikes before acquiring the business, reportedly close to $200 million in April 2018. Is the future of Uber in self-driving? Yes or no? Let's take a look. Like Google, Apple and Tesla, Uber was a frontrunner in the future of driverless cars. However, the road for Uber has become bumpy. Uber perhaps hit its worst yet in 2018 when a self-driving car fatally struck a pedestrian, causing the company to temporarily suspend all testing. In May 2018, Uber announced that it would halt its Arizona testing program but would conduct it elsewhere. In July 2018, Uber's self-driving cars made their return in Pittsburgh. but it was never the same again. In December 2020, it was announced that Uber would sell its autonomous vehicles business to Aurora Innovation, a startup in San Francisco that was started by the former head engineer of Waymo. Uber had invested more than $1 billion into the business at the time of sale. So is this a genius move or not? Uber has sold its rights on its self-driving cars for 26% ownership in Aurora. To me, this is going to break Uber's heart. From what I'm seeing, with Uber, they are taking short-term gain for long-term pain. They wanted to get to profitability with less growth prospects, is what I'm seeing. There's talk that Uber is going to open their own restaurants and only use Uber Eats, which seems like a smart play. If they create an Uber drink, it could be a game changer. But in terms of autonomous driving, I think they are fighting a losing battle, and with their $400 million investment in Aurora, I believe they will sell for under $100 million when Aurora fails. That's just my opinion, but Tesla, Google and Apple seem way more advanced in this area, and money will eventually run out for Aurora, but only time will tell. Uber versus LYFT. Competition has been ferocious between Uber and its closest rival LYFT. In 2014, both Uber and LYFT claimed that drivers and employees engaged in sabotage by regular hailing and cancelling rides on each other's service. Kalanick also openly admitted to trying to undermine LYFT's fundraising efforts in a Vanity Fair article. LYFT and Uber looked very different at launch. Uber mostly used black cars, SUVs, drivers dressed up and passengers sat in the back seat. Meanwhile, LYFT cars featured giant pink moustaches on the grille, and passengers were encouraged to sit up front and fist pump the bump driver. LYFT has mostly gotten rid of the pink moustaches and the fist pumps, and passengers now sit in the back seat. The services are nearly identical now. Uber and LYFT work in the same way. Request the ride through the app, get matched with a driver, track the driver on a real-time map, and pay the fee using the app at the end of the ride. Let's compare Uber and LYFT side by side through their financials. I have put them side by side on the screen. Let's go. Uber's market cap is 5 times bigger at $89 billion compared to LYFT's $18 billion. Short interest, I found it interesting. 10% of all interest in the stock is short interest in LYFT. And it's not surprising when you look at the figures. Growth revenue is minus 46% and issued more than 1,000% more shares in the last 4 years for capital raising, and they still have a net loss at $1.7 billion when in the same year revenue for LYFT was only $2.3 billion. Wowzers. Uber, to be fair, are not much better, with an $8.7 billion net loss, cash flow negative around $3 billion projected for the year. Uber is issuing more shares as well. 220% in the last 4 years is no good at all for an investor, as you own a lot less percentage of the business over that time. So what does this mean for you as an investor looking to buy into Uber? Well, for a start, LYFT looks like a disaster waiting to happen. You would have to do major research to see where their profit is going to come from, as at this rate, they look like their company's heading to bankruptcy. So how their share price is higher than Uber is just crazy, and a definite no from me at the current levels. In terms of Uber, which is the main source of this video, I'm concerned for the future of Uber, as they seem to be more focused on short-term profits by buying Postmates. For example, it only represents a small part of the whole eat delivery business, at a measly 5% in total sales in America. Selling off their self-driving technology and buying back into the same business at 26% seems very strange to me. Why sell off your assets if you're going to use it anyway, while still having to pay for 26% of the cost moving forward? Yes, there is a saving there in the short term, but if Aurora succeeds, Uber will be missing out on 74% of the profit. See what I mean? They are sort of hedging their bets. Let's take the money now, $10 billion, and then realize in 5 years' time it could cost tens of billions to keep paying for research and development of the technology. So losing that money and the original investment of $400 could all go down the drain. The only positive I have for Uber is investing into maybe their own restaurants and selling Uber drinks, for example. Uber hail rides, energy drinks, tea, coffee, all under their Uber brand umbrella. Uber restaurants could find a niche market, probably focusing on youth and the quick and easy meals delivered straight to your door. They could also do a frozen meal section, or even Meals on Wheels for the elderly for Uber Eats. Uber could be heading for profitability, but seriously doubt if they will ever grow to the potential they were aiming originally. I see them being profitable by early 2023, but I can also see them crashing and burning depending if the world opens up again and travel goes back to normal. Uber shares price to me is way overvalued on current metrics. They would need to be under $30 for me to get serious about adding more of a position. I did believe in Uber's vision initially, but at the moment they seem to be focused on the bottom line, which yes is important, but to me they are hindering potential long-term returns and possibly turning into a food company. Uber is at a precious time in its journey as a business. Some of the decisions now can make or break the company. Uber for me is more riskier to buy now as there are less potential revenue streams or selling of their autonomous technology. But maybe it's becoming more like Coca-Cola, a boring company to own now as the returns are going to be very low in terms of stock growth appreciation. With Uber's ride-sharing business could be a dying art once autonomous taxis come into force. With Tesla, Google, and even though Apple are quiet about what they're doing, they will leave Aurora and Uber behind. Uber could easily go to $200 if they find new ways to generate wealth and become profitable in the next few years. But they could also continue to burn cash, as with the rising costs they have to put their Uber Eats and Uber fares up, making them less competitive with taxis. Uber has a very interesting time ahead, and don't be surprised if there is a leadership challenge as Dara tries to reshape Uber, but it could be to the detriment of the company. Well, thank you for joining me today as we continue to learn about finance. Remember to seek professional advice before buying or selling any stock or cryptocurrency. These videos are made for educational and entertainment purposes only. Remember to push the guru like button as the knowledge spreads around the world with every like. Subscribe to the channel so you can see more of the videos you love. It's time for me to hail an Uber driver to drop me off at the movie theatre so I can watch one of my favourite Disney movies on the big screen, all by myself. Then I will indulge in a creme brulee dessert using Uber Eats from my favourite restaurant. Take care everybody, we'll see you at the next video. Sayonara.